Welcome back to Yahoo Finance Live, everyone. While oil prices have retracted from their highs seen in recent weeks, WTI and Brent back below $100, sustained high oil prices amid a rising rate environment continue to be a cause for alarm. And for more on this, let's bring in Stephen Schork, who is the Schork Group principal. Stephen, it's good to have you here with us today. So when we combine these two factors, net, what does that set up going forward from here, even as we do have Fed Chair Jerome Powell with commentary today saying that the headwind risks for a recession maintain mitigated at this point?
Yeah, I'm not so sure about that, Brad. When we look at the 6 previous recessions that we've had, beginning with the Arab oil embargo in the early 1970s, all 6 recessions were preceded by a significant rise in energy costs. Now we have that rise going on now, and the rise we've seen in such a short amount of time is unprecedented. So we're clearly have that headwind as far as economic growth goes. Today we saw the retail sales numbers. They were up lower than thought, 0.3%, but all of the growth virtually came in gasoline station sales. So what we paid at the pump in February was 5.3% higher. If you take those sales out, then retail sales last month actually fell. So clearly we're at a point where consumers now are starting to feel the impact of these higher energy costs. And of course, every dollar that goes into the gas tank is a dollar that does not get spent elsewhere in the economy. And that's a problem for an economy that is based on 70% of consumer spending. So with these high costs, $4.33, we've never seen anything like this before. And clearly we're in the weakest demand part of the season. In the months ahead, travel demand will pick up, and that is certainly going to underpin prices going forward.
Okay, and so I want to talk about that travel demand as well, because not just at the pump, this is also going to play into where airlines even perhaps pass through some of those costs to consumers at the end of the day. It also raises a larger question of when airlines, quite frankly, are purchasing their supplies for fuel at the end, because that, too, is going to weigh into the prices for tickets that consumers are paying in the near term or even months out from now. But as we think about what that travel scenario looks like, we just heard from airliners that are anticipating higher demand, but at what price for consumers?
Yeah, absolutely. The higher demand is going to come with a higher price. Right now here on the East Coast, here in Pennsylvania, we have the Monroe refinery, which is a very important refinery as far as jet fuel is concerned and the production thereof. And the airports in New York City and Philadelphia are depending on that refinery. That refinery last year got most of its oil from Russia. Now we're not getting that oil from Russia, and therefore the refinery will have to go out and source oil from elsewhere at a cost, of course. So that cost will get transferred. So you have rising demand and rising costs on the jet fuel scenario. So higher prices are unavoidable at this point, and demand is strong at right now. Same goes for gasoline. We're going to see very strong demand for gasoline, but gasoline's already at $4.30. And we're only consuming winter grade gasoline. Next month, refiners will have to start to produce and supply summer grade gasoline, which is more expensive to produce. And historically, the difference between winter grade gasoline and summer grade gasoline is approximately 30 cents. So in the months ahead, even if crude oil prices don't go any higher from here, if they stay here, we're automatically looking at probably $4.50, $4.60 on a national average as we all start to head out to the beach or out to the lakes.
Stephen, what is the level? What's the price that you would be tracking for oil prices for WTI or for Brent, where that would ultimately signal to you that there was going to be, if maintained at a kind of extended period of time, would signal demand destruction that would then kind of send off or trigger some recession warnings?
Yeah, it's a great question because the calculus on that has changed. You need 2 things to impact demand. Elasticities, you need price shocks, which going back to the 70s, we've certainly had spikes and collapses in price, but we never had the other variable until recently. And that, of course, is the substitute or the EV or the electric hybrid. So what we know historically, adjusted for inflation, once gasoline prices would get up around $3.60, $3.70 on a national average, that was your inflection point where you started to see demand destruction. The demand is not as inelastic now for gasoline because of, again, the number of substitutes in the market. But clearly, we are now at $4.33. We're certainly pushing up against that. If we do get a rise to $125, $150 barrel crude oil by the start of the summer, our quants are putting about a 25% probability we'll get to 125, and an 18% probability now we'll get to 150. Now we're talking about gasoline prices on a national average of over $5, potentially as high as $5.25, which would be the all-time high adjusted for inflation. So we're certainly in that ballpark now about the inflection point, but by all indications, demand still remains strong. So we're not there yet. But I venture if we push north of $125 crude oil, you'll start to see demand fall.
Stephen Schorr, the Short Group principal, joining us here today. Always a pleasure to get some of your insights and calculus. Thanks for breaking that down for us.